And welcome back, options traders. Good afternoon, everyone. I wanted to talk a little bit about an interesting question that I've heard traders talk about before, and that is, do we have a delta danger from splits? In other words, if a stock does a split, does it pose a special danger to options traders because of deltas? Well, let's take a look. First of all, quick review on a stock split. What is that? Well, there's all kinds of stock splits. Typically, they're in what are called whole splits, so things like 2 for 1, 3 for 1, but you can get into all kinds of crazy things, 5 for 4, 8 for 7. But the idea is that you're just increasing the number of shares that you own, and you are changing the stock price by a proportional amount. So let's say that you own 100 shares of stock currently trading for $100. Well, that's a value of $10,000 worth of stock. But then it goes through a 2 for 1 split. After the split, you're going to hold 200 shares, twice as many shares, at a price of 50, at half the price. But take a look, the value is still $10,000. So we had $10,000 worth of stock prior to the split, $10,000 after, so again, the values stay the same. And this is the important thing to understand about stock splits, is that they don't really change anything. It's no different than getting 2 5s for a 10. Yeah, you might have more pieces of paper in your wallet, and the same thing here, you've got more shares, but the total value of the position does not change. Now, sometimes people think, yeah, but I've got twice as many shares, so if the stock goes up $1, I'm going to make $200 instead of $100. Well, as we're going to find out, the chances for that stock to rise $1 are not the same. So kind of hold on to that thought. So the idea here is that, is this stock split going to adversely affect us for options? Well, let's say that you're holding a $100 call currently trading for $10. There's an exercise value there of $10,000. If you exercise that call, you're going to pay the strike of 100 times 100, which would give you $10,000. I could also say I'm currently holding $1,000 worth of the option. $10 price times 100 shares per contract. It's worth $1,000. But now it goes through a 2 for 1 split. After the split, I'm going to be holding 2 $50 calls trading for 5. Everything gets cut in half. The strike price gets cut in half, and the options price gets cut in half. But I'm now holding twice as many contracts. But notice that I still have a total exercise value of $10,000. If I exercise 2 calls and pay the $50 strike, it's still going to cost me $10,000. So those values right there are exactly the same. And if I want to compare the option prices, 1 contract trading for 10 is $1,000, 2 contracts trading at 5 is $1,000. Nothing has changed. But what about the deltas? Do we have a delta risk here? And this is the argument or the concern that some options traders have asked. So let's say you have an at-the-money option, $100 call with a delta of 50. At the money, again, means that the stock is currently trading for 100, and we all know that that delta is going to be about 50. After a split, again, let's assume a 2 for 1 split, you're now going to be holding a $50 call, and it will still be at the money. And so because it's an at-the-money call, it will still have the same delta of 50. However, you now own 2 of these $50 calls, so your total delta is 100. And this is the question that people have asked and saying, well, are you at greater risk now because you've got a delta of 100? Well, immediately following the split, when your deltas are the same here, you're not really at any risk. And that's because, as I just mentioned a little bit ago, the percents stay the same. So if you have the $100 stock pre-split and it moves $1, let's say based on some news, after the split, when that stock is trading for $50, that would equate to a 50-cent move, that same news. Why? Because both of these changes represent a 1% increase. And stock prices move in percentages. So that means prior to the split, when we were holding the $100 call with a delta of 50, the stock rises $1, our option is going to increase 50 cents by delta. But my $50 call after the split is also going to rise by a delta of 50, but it's an increase of 50 cents. So that means my call option is going to rise 25 cents. But did you forget? We're holding 2 of those calls. So that means it's going to rise 50 cents as well, at least my total position. So once again, 50 cents, 50 cents, there's not going to be any change, at least at that moment, assuming you're holding an at-the-money option and it goes through a 2-for-1 split. Well, where does a risk come in? What about gamma? Gamma for a $50 stock is going to be 2 times greater than for a $100 stock. For reasons that I just kind of touched on there, the curves here are going to be different. The blue curve shows us the stock at 100. The red curve shows with a stock at 50. So both curves represent the total range that the stock prices can move. The percentages are the same, but the range is greater for the $100 stock. But we do have a much greater gamma. It's going to be very tall and peaked, as shown by this red curve here, when you've got the at-the-money $50 call. So it's not really the delta that becomes the risk. It becomes the changing deltas, which is gamma. And that's another reason why I wanted to show this video here, is it's often an overlooked risk by options traders. They understand the delta, but they don't understand that those deltas can change and why that even matters. So let's go over to an Excel spreadsheet and see how this is going to affect your positions. All right, so what we're looking at here is the number of calls. I'm going to assume that we were holding 5 calls prior to the split, and then therefore we got 10 calls after a 2-for-1 split. Prior to the split, the stock was at 100. After it's trading for 50, as I talked about, the deltas at that moment would both be 50. And let's say that right now the gamma, when the stock is at 100, is 0.07. And therefore, when the stock splits to 50, it's going to double. You're going to have a gamma of 0.14. This is what we're going to find out is the risk. Now let's say that the stock price rises $1. So it was trading for 100. It now increases to $1 to 101. That means that that same news would drive my $50 stock up by 50 cents, or to 50.5. So how is that going to affect these positions? Well, if we have a delta of 50 and the stock rises $1, that would be an increase of 50% of that, or 50 cents. So prior to the split, our total position, whatever it's trading for, is going to increase by 50 cents. What about after the split? Well, the stock increases 50 cents on that same news with a delta of 50. So again, that's a 25-cent change. But I own twice as many contracts. So notice if I take the 50-cent change times 5 calls, I have a change of $2.50, or $250 for that position. After the split, because I own 10 calls that have changed 25 cents, I also end up with a change of $2.50, or $250. So right now you can see there's absolutely no difference, just like it is for the stock trader. But here's where things start to change. The next dollar move, I'm not going to keep my deltas at 50. They're going to change. That's what gamma shows us. So over here, my new delta is going to be 57. I'm getting that by taking the old delta of 50 and adding gamma to it. That's what gamma shows us, is the rate of change of those deltas. So now I'm sitting on a delta of 57 pre-split. But after the split, I would have an at-the-money option with a delta of 50, but I've got gamma of 14. So on that next move, I would have a new delta of 64. So the second block down here is exactly this one just copied down. But what I'm doing is I'm just copying this stock price down and this stock price down. I'm also creating the new deltas pulled in from here and here. And for right now, I'm going to assume that our gammas are going to stay the same. Probably not going to be a big change, especially if it's a fairly quick move. So I'm going to keep the gammas the same. The stock increases from 101 right here to 102. And that means that my stock that was trading for 50.5 is going to increase half that amount, or 50 cents, to 51. But take a look at what's happening to our calls now. My call option pre-split picked up this dollar move times a delta of 57 or 57 cents. My $50 stock or 50.5 stock here with a gamma of 14 is going to increase 50 cents, right, from 50.5 to 51, but we're going to pick up 64% of that move, which is 32 cents. So right off the bat, it kind of looks right here that pre-split we were better off. But remember, we've got twice as many contracts. So pre-split we had 5 contracts times a 50-cent change for $2.85. After the split, I've got 10 contracts with a 32-cent change for a change of $3.20. So look at that right there. See, these changes are no longer the same like they were up here. And that's because of gamma. So even though stock splits typically don't affect stock traders and really for the most part options traders for the at-the-money options, once the stock starts moving, gamma does affect the equation. And now, again, I'm going to get new deltas and new gammas. My new delta here is at 64, which is the old delta plus 7 gamma. But after the split, look at this. I had a 64 delta with a 14 gamma. And now I've got a 78 delta. So if we go through the same routine down here in this block, we can see that if you were holding 5 contracts pre-split and the stock rises $1, you would pick up $3.20 or 320 bucks. But after the split, you would pick up $3.90. We do it again. Look at this. You go to $3.50 compared to $4.50. Look at these changes now getting much bigger. But that's only going to last so long until we hit Delta 1. And our $50 stock is going to hit Delta 1 much sooner because that curve is taller and skinnier. We're going to move through it faster. So once we kind of top out here at 1, now look what happens. See, now we had a dollar difference between these two positions. Now it's actually increased again to $1.25, but eventually what happens? We start decreasing. And that again is because our option down here after the split eventually tops out to Delta 1. And then the stock trader here, assuming the stock didn't split, would eventually catch up. This delta is eventually going to match, and at that point, the two positions are going to behave identically because they're both mathematically the same as stock. But prior to that moment, when both options are trading for Delta 1, you do have a risk. But it's not a risk of delta, it is a risk of changing deltas. Now, why do some traders think it's a delta risk? Well, if you go back and you look at the math, you will see that the deltas here will exactly match your total dollar change. And that's why I've highlighted these in red. So it looks like it's a delta risk, but it's not. It's the changing of the deltas. So for example, come up here, watch if I make these both 0.7. Again, you'll see that the dollar changes are the same. It's not the deltas that are causing the risk. It is the change in the deltas that's causing the positions to behave differently. Now, if that's not complicated enough, we've only looked at the stock price increasing. And should we say it's a risk or is it a benefit? After the split, we're going to accelerate those profits, at least in terms of dollars. But that also means if it turns around and heads south on us, we're going to lose them faster until we hit Delta 50 and then start decelerating. So if you go through the same thing with the dollars changing in our stock, which is what I've done on this page, you'll see that the person pre-split actually loses more, $2.15 compared to $1.80, $1.80 compared to $1.10, and eventually we're going to find out that the person pre-split is going to continue to lose, whereas the person after split is going to bottom out. But this again is from gamma. So is it a risk? Well, that depends on how you define risk. And that is why it's so important for you as an options trader to understand why things are changing. Could I say that this is good or bad? It depends on what you're trying to do. But the question is, if you didn't understand that this effect is going on behind the scenes, that's where you're going to step into potential traps. And that's why it's so important to understand the art and science of options trading. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find the link in the description below.